In the meantime, Fidelity Bank on Tuesday reported an 81% growth in gross earnings for the third quarter of the year. Now, however, profit before tax and net profit came down for the period. Joining me now in the studio to unpack these numbers for us is Francis Ikenga. He's the Chief Strategy Officer at Fidelity Bank. Thank you so much, Francis, for joining us. And let's get straight down to the numbers. Gross earnings up 15% at 92.7 billion, but we're looking at lower numbers for profit before tax and net profit. Tell us what the pressure points were.
I think if you take a look at the numbers, the balance sheet has strong capacity to generate and deliver growth. But incidentally, from the income statement numbers, you see that the pressure is there. The pressure is specifically that of a regulatory burden. The regulatory burden has three-pronged impact, which I will say first is the 50% hike on public sector cash reserve ratio, which crippled, liquidity in most banks and the system as well. And it sent volatility across financial markets in Nigeria. Second point is the issue of the tariff reforms in the banking sector, which has significantly reduced earning capacity in terms of fees and commission, which the banks can make on an ongoing basis. And for us, that is a key part of our income. Then the third part is the additional to cost. You are aware that in 2012 and in 2011 as well, the industry resolution cost, which is made payable to AMCON, was 0.3% of total assets of banks. And for us in 2012, it approximately 2.2 billion naira. But in 2013, it was raised to 0.5% of total assets, and for us it came in around 4.6 billion naira impact. So these are the three-pronged impact that caused the PBT to come down below what expectation, I will say.
Now, for the regulatory burden that you mentioned, the CRR, the cash reserve requirement that was hiked to 50% for public sector deposits, how exposed was Fidelity Bank?
On the average, our public sector deposit in this period has hovered between 13 to 15% of our total deposits.
Is that something the bank, or how quickly can you recover from this?
I think the point to raise here is that the public sector component is a major part of the Nigerian economy, which nobody can very completely afford to neglect. But the other thing to say is that it's necessary for banks to move away from public sector business and develop their core business, which is in the retail segment of the economy. And we have already commenced that. We've been doing that, but we have refocused a lot more sharply in this regard. You will have noticed that we've become very strong in the SME segment, and we've pushed up our numbers in this regard. And again as well, in the consumer one-on-one individual business, we have refocused strongly, and both in terms of the asset side and in the terms of the liabilities side. So that has become very strong for us. The next thing we need to do, because that will afford us the capacity that is necessary for us to deliver growth in the months to come. The next thing for us is to take a second look, which we are currently doing on income, non-interest income side. On the average, non-interest income has been a major part of our total income on an ongoing basis. But what is going on now is the impact that we have from the regulatory side. So if you take a look at what a breakdown is, approximately 20% of our non-interest income comes from foreign trade-related income, and about 10% from COT, and about 13-14% from credit-related fees, and about 52% from service charges, which are delivered from channels and processing efficiency. Now, what I think for us is to deepen our participation in the channel capacity, in the processing efficiency, and in franchise products in order to deliver a lot more non-interest income that are not subject to regulatory impact.
What about the retail space? Because I know that that's going forward is going to be a major strategy for not just tier 2 banks, also tier 1 banks, but it looks like we all know that tier 1 banks, as a way, have more muscle, and obviously they have said that they will be more visible on that front. So how do you intend, or how does Fidelity Bank plan to stay ahead?
I think the point for Fidelity, which sets it apart, is that we have a very well recognized and respected brand in the market, and it's well recognized, particularly among the youth market and in the business segment. So that is why our target in the small and medium scale enterprises segment and our target in the consumer segment is paying off. Over the past 7 months, we've recruited over 300,000 accounts in this core retail segment, and that is an addition. And that goes ahead to impact on our lower cost lower cost funds in terms of savings deposits and little retail consumer current accounts. So this is where we are focused currently, and we will continue to drive that because of the impact it has to deliver returns.
Okay, so how much of that would change the numbers? Because looking at these numbers, we're obviously, PBT, net profit in negative territory. So are you going to go back to profit? And can you just give us can you just forecast some numbers for us, numbers we can look forward to for the next quarter?
I think in the next quarter we will experience growth. But what it is that you're aware that the tightening from the regulatory perspective is still there. So what happens is that the growth that will be delivered will be in tandem with the market environment that we'll see. But I expect that the growth, based on what we have seen in October and in the later of September, and again, what you note is that over the months, over the years, year on year, we've experienced about 35% growth in the loan book. Okay. And the better part of the loans, in December, year-to-date September, we had about 19% growth in the loan book, and much of that loan was done in the third quarter of 2013. So you will see the impact of those loans materialize in the earnings to come. And you may be aware that we supported about 6 of the electricity generating and the distribution companies.
Okay, so more money for you,
more money for us, and more impact for the PNL.
Okay, so let me just quickly ask you this. No one saw that CRR coming when we at that MPC meeting. Does it make you, the change in regulatory environment, does it make you nervous? Do you wake up thinking, what's the financial regulator going to come up with this time?
No, I think for us, we've always known that it was going to come. We've always known that, first of all, that the public sector business was going to be taken away one day. But the thing is when. Because, first of all, they had been talking about a single treasury account before they come up with the CRR. So it's something that we know will have to happen. But the thing is that you don't leave money on the table and you don't fix what is not broken. So as a result, it was fine to continue with that business because it's still a baked bread at that point in time. Now that bread seems to be taken away from the table, then it's important for banks to go back to the core of their business. And Fidelity is in the forefront in this regard.
Well, thank you so much.